All right, we're beginning our reading on the valuation of bonds with embedded options, and our first learning objective just says, hey, tell me about what an embedded option is. What's the vocabulary here? So let's make sure we have that down, because we want to make sure that when we use a word, we all mean and understand each other when that word, we all mean the same thing and understand each other, when that word is used. So an embedded option is a contingency provision that can be exercised by the holder or the issuer, or automatically, depending on the course of interest rates. And that's the critical thing. These embedded options, they're part of the bond. You can't separate them. And you can think of a bond as a derivative contract on an interest rate, which means the exercise of the option must be interest rate dependent, depending on the course of interest rates. These options are not independent of the bond and hence cannot be traded separately. Hence we get the word embedded. So let's look at call options or callable bonds. This benefits the issuer because they get to call it back if interest rates drop, and they can reissue the bond at a lower rate. Off they go, right? Typically, when a bond is issued, let's say at time 0 and it matures at time t, there's a certain period of time where the call option is suspended. This is called a lockout period. So as a bondholder, as an investor, I know that I have at least a certain amount of time where it cannot be called on me, and maybe this time period is first call. So there's a lockout period to first call. If it's a European call on the bond, there'll be a single date to call, which means it will be the lockout period. European calls will typically have a longer lockout period than would be a shorter one. If it's American call, which means that as soon as the lockout period is over, it can be called at any time. American calls typically lend themselves to a shorter lockout period, along with Bermuda calls. Bermuda calls will typically have an intermediate to shorter term period. The European call will have the longest lockout period. A Bermuda call is like a European call and an American call. It's not callable continuously, nor is it a single date, but it could be multiple dates. Maybe every anniversary date, every year, it could potentially be callable. So let's look at an example of one. A government-sponsored entity, Fannie or Freddie, have bonds that are all pretty much callable at 100% of par. The lockout periods are anywhere from 3 months to 1 year, and they are Bermuda style. Embedded options that are put options, these are puttable bonds. This benefits the holder. Puttable usually at par. They're typically European, sometimes Bermuda, but never American. Because the company is issuing them, it's giving a benefit to the investor, but at the same time, the company is not going to say, look, go ahead and put it to us at any time. They're going to give something and take something away at the same time. So they're going to give you the put option, but they're going to take away the American style. They'll even take away the Bermuda option of having multiple put dates. Typically, there's only one date, so they're mostly European puts, which is kind of like an extendable bond in a way. Let's say that you have a 5-year bond that's extendable to a 7. You have 1 day, there's a date where you have to decide and exercise your extension. And if you don't, well, after 5 years, it's the same as having a 7-year bond and putting it after 5 years, right? It's sort of like a put. The holder can redeem, which is like putting it, or extend for the other 2 years. And finally, you have bonds with complex options. We've just covered basic call and basic put. You can have a bond that has both callable and puttable. You can have convertible, and we'll look at convertible later on in this reading as well. Convertible bonds typically are also callable bonds. And they're typically callable bonds so that they can force conversion. It's usually embedded in something called a force conversion clause, that if the price is at a certain level for a number of days, the company can call the bond at a penalty rate, thereby forcing the holders to convert. Contingent options in the curriculum, or the book gives you a good example with something called an estate put. I have actually never heard of this until I read it in the curriculum. This is the first time I've come across an example like this, where a contingent option is contingent on somebody. I could be holding a 20-year bond, and if I pass away, my heirs can put it back to the corporation if it's selling at a discount. I honestly have never heard of this one before, so you learn something every day, right? Sinking fund provision, also callable. It may have an acceleration provision, which means you can retire it faster. So rather than retiring 5% of the of the fund every year. You might be able to do 2 times or 3 times, 10% or 15%. And a delivery option. Sinking fund provision means that every year, let's say on a 20-year bond, I have to put 5% of the available funds with a trustee. If my bonds are selling at a discount, I can go in the open market and buy 5% of them back and deliver the bonds themselves as part of the sinking fund if I have that delivery option. So you could get really complex. Try to price something like this out. Becomes very difficult. So now that we sort of have an idea of the types of options that are embedded in bonds, we ended with a very complex description of what a bond could look like. And just to put your mind at ease, you would not be expected to price something like that out. Even the bond players at the top of their game would still find that a very challenging thing to price out. And you don't need to. You just need to understand how it's done. So let's just look at some typical questions that could be asked based on what we know so far. Investors in puttable bonds most likely seek to take advantage of, well, what would you think? Interest rate movements, changes in the issuer's credit rating, or movements in the price of the issuer's common stock? Well, it wouldn't be common stock. I think we can just eliminate that one right away, because that would be a convertible bond, right? Interest rate movements or changes in the issuer's credit rating. Now, you could argue it could be both. That if the issuer's credit rating dropped, the required return would jump, thereby reducing the price, and you'd want to be able to put it back. But you typically don't buy a bond that's puttable with the idea of saying, well, just in case the credit rating dropped. Typically, you're saying, look, I want to hedge out any interest rate risk, so that if interest rates do go up and the price of this bond drops, I want to be able to put it back. And again, you got to watch the wording, and the CFA is pretty notorious for this kind of stuff. This is not asking for a one answer. It's not saying that one of these are correct. It's saying most likely. So while you can argue B, yes, you can argue B, and you'd be right. What is most likely? Do investors buy bonds most of the time hedging out credit risk, or do they buy bonds, puttable bonds, for most of the time hedging out interest rate risk? So you'd probably want to select A on that. The decision to exercise the option embedded in an extendable bond is made by, and well, it's kind of like a put, right? So we know that benefits the holder, it's the bond holder. And finally, the conversion option in a convertible bond is a right held by the bondholders. So this is a rather short learning objective. If you get the idea that a call option benefits the issuer and that a put option benefits the holder, something that benefits the issuer has to be paid for, and something that benefits the holder has to be paid for. So the value of a callable bond should equal the value of a straight bond minus the value of the issuer call option, because it benefits them. We have to be compensated for that, so we're compensated for it by buying a callable bond. If it's the same, you got to now keep in mind, now we're talking about the same credit quality, the same type of issuer, that these two would be comparable. The only difference between them is one has a call option, one doesn't. The callable bond will be discounted from the price of the straight bond by the value of the call option. A equals B minus C. So you can also rearrange that and isolate C, the value of the call option here, as equal to B minus A, the value of the straight bond, minus the value of the callable bond. The value of a puttable bond. Now, who does this benefit? It benefits us. So it should be the same as a straight bond, but if it has a put option, it has more value, so we should be adding the value of the investor put option. So the puttable bond is equal to the value of the straight bond plus the value of the investor put option. Now, it doesn't take much thinking to say, well, what if they both had a call and a put? Here we have the straight bond under both conditions. We're subtracting the value of the call and adding the value of the put. So we can see that they may offset each other, thereby equaling the value of the straight bond, or much closer to the value of a straight bond than either just a callable or a puttable on their own. If we look at this in terms of D, E, and F, we can isolate F being the value of the put is equal to D minus E, which is the value of the puttable bond, minus the value of the straight bond. So we can isolate the value of either the call option or the put option. And these relationships hold for when we have arbitrage-free values for all of these. That's what this chapter is going to do. We're going to learn how we get to an arbitrage-free value for the value of the embedded option. So before we go really deep into the chapter, let's introduce an example that we'll use throughout the chapter to move from valuing a bond, which we'll do here, a callable bond, with zero volatility, to moving to introducing volatility. So here is our par rates, 2, 5, 3, and 3.5 for 1, 2, and 3 year bonds. We can derive spot rates of 2.5, 3.008, and 3.524, which implies these forward rates. So let's take a 3-year 4.25% annual bond. This is an option-free bond. Let's use that as our baseline straight bond. How would we find the value of this bond? Well, we know our cash flows, if it's 3-year 4.25, is 4.25, 4.25, and 104.25, and we would discount each one by its appropriate spot rate: 2.5, 3.008, and 3.524. We get 102.114. The other way we can do it is, here's our cash flows again, is discount the first payment by the comparable forward rate, which is the spot rate. The par, the spot, and the forward are all the same. Then we could discount it by the combination of for the forward 1 and 2, 1.05 times 1.03518, and then finally the last one by multiplying all three together, we get 102.114. If you'll recall, in the last chapter, the trees that we built, the nodes were centered around the forward rates. So using the forward rates, using this lower methodology here, is a better approach for bonds with options, which is the approach we'll be using, because we'll be using the tree. When we're using the tree to discount the cash flows, we know that we're using rates that are centered on the forward rate, not on the spot rate. So let's have a let's make this one callable now. This 3-year 4.25% annual bond. Let's make it callable, and we're going to assume zero volatility. Zero volatility, which means we got a flat forward curve, and there's zero volatility, which means we will simply use the forward rates at each of the nodes. It's callable each year if the value at that particular year is greater than 100. So as soon as it's in the money, as soon as the option's in the money, it'll be called. So let's have a look at what we have. So at the end of year 2, remember this is a 3-year, so we got to discount back the 104.25 to the end of year 2. Let's see what we get. At the end of year 2, we will have, what is our cash flow? 104.25, and we're going to discount it by the forward rate at that period of time, 1.04564, and we will get 99.70. So is it greater than 100? No, it is not. So the company would not call, or the issuer would not call this bond, because the argument would be, why would we call it at par if it's 99.70? We could simply just buy it in the market if it's 99.70, so we wouldn't call it. So let's go back to the end of year 1 and see what we have. Well, we have 99.70 plus, remember now, we add our coupon, right, 4.25, and we'll discount this by the spot rate for the year, for period 2, 518, and we will get 100.417. Now, this is in the money, so it would be called. We said here it'll be called if the value is over 100. Here's the logic behind this. It may not be called. The company may look at this and say, well, that's really not worth us calling. Let's just let it run. But for valuation, we're going to assume that it will be called, because we want to isolate the value of the option. So what we don't want to do is we don't want to discount back any portion of the bond that's in the money. So what we do at this point is we say, we'll just make the assumption that it is called at 100. We're making the assumption also that this is a Bermuda style option, that it can be exercised only on the anniversary date. So it's at 100.47. We're not even going to decide whether it's in the company's interest to call, because they might just say, let it run, we're good with that. They might have other reasons why. They might be constrained. They might not be able to refinance. It's not guaranteed that just because it's advantageous to call that it will be called. It's not guaranteed. But what we don't want to do, again, I want to stress this, is we don't want to discount back the in the money portion. So what we do is we write it down to 100. We're only going to discount back the 100. We're going to let the 0.417 out of it, and that will isolate all of the in the money components of the option along our pathways, thereby giving us the value of the option. So today we discounted back one more period. We're going to discount back only 100. We're going to leave the 0.417 out. We'll discount back the 100 plus the 4.25 by 1.025, and that'll give us 101.707. So we can now find the value of the call. So value of call equals the value of our straight bond, 102.114, minus the value of the callable bond, which is 101.707. And if you do the math on that, we'll get 0.407. 0.407. Look what we left out. We left out the 0.417. We left it out back there. So the value of that today, because we discounted the rest back, the value of that today would be 0.407 because it'll be in the money at this time, and we're just going to assume at that point that it's called. So we're going to see other examples where there are multiple times where we write it down to 100, and if you look at everything we left behind and the value of the call, the value of the call is very close to the present value of what you would get if you discounted it back by all the in the money components, 0.407. All right, let's change this to a puttable bond. We have the same example up top here, a 3-year, 4.25% annual bond, but this time it's going to be a puttable bond, and it's puttable each year, so it's Bermuda style. If the value of the bond at that time is less than 100, again, zero volatility. Once we introduce volatility, of course, we're going to have upper and lower bounds on each of the forward rates per period, but here's zero volatility. So what do we have at the end of year 2? We have to discount back our cash flow, and at that point it's 104.25, and we're going to discount it back at 1.04564, and we will get 99.70. Is it less than 100? It is. So it's in the money by 30 cents, or by 0.30, right? So what we don't want to do is we don't want to discount back the in the money portion. We're going to put it at 100. So that means we're going to discount this period back 100 plus 4.25 to get the value at the end of year 1, divided by 1.03518. We will get a value of 100.707. Well, that's out of the money. We'd only put it if it's less than the money, so we're not going to change that. We'll discount that back, the 100.707. Add, of course, our coupon, 4.25 and 1.025. This will give us 102.397. So we can figure out the value of the put. The value of the put. What do we have? 102.397 minus the value of the straight bond, 102.114, gives us 0.283. Now, to show you the relationship between the price of the put here, 0.203, and the portion by which it was in the money, what we need to do is bring 0.283 forward to that period of time. So if you multiply 2.283 by 1.025, which is the 1 year, and then you multiply it again by 1.03518, you'll find that you get 30.30, which is this value. So you can think about what we're doing here in terms of we want every decision we make, at every valuation we get, if it's in the money, let's take the in the money portion out and just discount back the strike. Call it the strike price. So if it's puttable at 100, we're at 99.70, it's in the money. Let's just discount back the strike price as opposed to this value. the value that we get if we bring it forward over through time, you'll find that this is just the present value of whatever the in the money portions were, which is a no arbitrage or arbitrage free valuation on the option. All right, let's try a few questions. Let's make sure we understand what we're doing here. Bond A, bond C, bond C. Sorry, A, B, and C. Bond A is option free. There's our straight bond. Bond B is a callable bond at par in year 2 and year 3. And bond C is both callable and puttable at par in year 2 and year 3. We get that? Great. Relative to the value of bond A, the value of bond B is lower, the same, or higher. Well, B is callable. Who has the value in a callable bond? It's the issuer. If the issuer has value, well, we need to be paid for that, which means we're not going to pay the same price as a straight bond, lower. Relative to the value of bond B, the value of bond C is, well, if we look at bond B and bond C is bond B with a put option. So whatever the value of bond B is, bond C is the same thing with a puttable, because it's also callable, right, with a put. So who has value with the put? The holder has value, so bond C should be higher than bond B. Under a steeply upward sloping yield curve, bond C, callable and puttable, will most likely be called by the issuer, be put by the bondholders, or mature without exercise of any of the embedded options. Now, it's saying will most likely, so we're going to assume that something is in the money. Is it the call or the put? If the interest rates go up under a steeply upward sloping yield curve, of course, if that's the spot rate, the forward rate is above that. If we're using the forward rate, which we are in our tree, at each node, we're going to have lower and lower prices, right? Higher interest rates, lower prices. Lower prices induce us to put the bond back. It will be put by the bondholders. All right, well, let's look at the effective interest rate volatility on the value of our embedded options. And it should come as no surprise. I mean, we've done level 1 derivatives, and we can see the effective volatility, which is an input into the valuation of an option. The more volatility we have, the higher the value of the option, right? The value of the embedded option increases with interest rate volatility. But as we're going to see, the price of the bond does not change as interest rate volatility changes, only the value of the embedded option. So let's have a look at what we have here. The process generating the tree, given yield curve volatility assumptions, would look like this. We would get a tree, and remember I said that you can conceive of a line like this so that at each interest rate period, the rates in the tree are centered around the forward curve. So we generate a set of potential forward rates at each time period. Well, as volatility increases, this then becomes wider, so that the distance, if you look at the first rate around the forward rate, the spread between the very top and the very bottom becomes bigger, because remember now, we're taking whatever rate we get, F1, and our first best guess for going up and down, if we're going down, is e to the negative sigma. Well, sigma is our measure of volatility, so as that increases, the number of basis points downwards increases and upwards increases. So the greater the volatility, the wider the dispersion in interest rates. Okay, well, let's have a look at a callable and a puttable bond. We'll start at a callable bond here, and let's get some kind of benchmark up here. Let's look at a 30-year callable bond at par in 10 years, 4.5% coupon. We're going to assume a 4% flat yield curve. And all we're going to do, if you look along the bottom here, is we're going to change the interest rate volatility. So let's start with this red line right across here. This is we have level bond value no matter what rate of volatility we have. The volatility doesn't affect the tenor of the bond. It's still a 30-year. It doesn't affect the coupon. It's still a 4.5% bond. It doesn't affect the yield curve. at all. It's still a 4% flat yield curve. So given all of that, the price of a straight bond is not expected to change. Now remember, a callable bond is a straight bond minus the value of the option, minus the call option, right? So let's look what happens when volatility increases. At low levels of volatility, the call option that's embedded in the bond, it still has value. Keep in mind, this is a 30-year bond. It's callable in 10, so even though it's out of the money, there's a lot of time value left, but it only represents 4.6% of par, the value of the embedded option. But as interest rate volatility increases, look what happens to the value of the call option. At 30% volatility, the call option now represents 14.78% of par. So you have increasing call option value as interest rate volatility increases, decreasing callable bond value because the callable bond is the straight bond minus the call option. And if the call option gets more valuable with higher volatility, then as volatility increases, the price of the callable bond would drop in the market, but the straight bond price would be unchanged. Now let's look at the value of the put. We'll look at a same tenor, 30-year bond, but this time 3.75% coupon, puttable at par in 10 years, and we're going to still say we got a 4% flat yield curve. And remember now, the put adds value for the investor. So given a straight bond and a puttable bond, the investor would pay more for the puttable bond because they're getting value from the option. So you can conceive of a line, a straight line like this, representing what a straight bond would be. This is level value of a straight bond, unaffected by volatility again, unaffected. And we notice that it's below par. Does that make sense? Well, if we got a flat 4% flat yield curve and it's a 3.75% coupon, it's got to be a discount bond. So if we have an unchanging yield curve week over week, but volatility is increasing, you can look at the price of a puttable bond and the price of a straight bond. The straight bond will not move in price, but the puttable bond will increase in price. Why? Because the option is worth more at higher levels of volatility. And since the option has value for the holder of the bond, then obviously the value of the bond would increase. At zero volatility, the put still has value even though there's no volatility. Zero volatility is assuming, well, you got a flat yield curve, and even if we did our tree with zero volatility, there'd be no need to do the tree really. It's just a straight curve. The put still has value, 2.3% of par, because there's still time value. There may be no intrinsic value. It may be out of the money, completely out of the money here at 3.75. Given a 4% yield, it's clearly out of the money at this point. Represents 2.3% of par. Nothing changes but volatility. We hit a rough patch, but rates stay the same. You get up to 30% volatility, 10.54% of par. So the put option increases in value. Well, not just the put, right? We saw that the call increases in value. So as volatility increases, a straight bond will not change in price. A callable bond will drop in price, and a puttable bond will rise in price. Okay, let's look at the level of the yield curve. We've looked at volatility. Now let's leave that constant and let's change the level and look at what we have here. First of all, rather than looking at the gray and the white, let's just look at the size of the bar in total, and that is our straight bond. We know that because the straight bond minus the option equals the callable bond, right? Well, look what happens with the straight bond. Let's first of all make sure we know how we're reading the chart, right? We see the value of the straight bond decreasing as interest rates rise. Does that make sense to you? As interest rates go up, the price of the bond as a percentage of par drops. Yes, as rates rise, the value of a straight bond declines. Great. Let's look at what happens to the value of the option of the call in here. At higher rates, is that bond going to be called? Well, probably not. The higher the rate that you get, this is a 4.5% callable bond, so at 5%, it's going to be below par. Look at the value of the call option here, represents 5.37% of par, while the callable bond is 86.9% of par. As we lower interest rates, well, suddenly it makes it more worth it for the company to start thinking about calling the bond, because then they can reissue another one at a lower rate of interest. They're paying 4.5. So as we go to 3.5 and then 3, look at how big the value of the call option gets versus what it was when it was out of the money. We can say that anything below 4.5, let me get a better color here for you, anything below 4.5, this call option is now in the money. And anything above 4.5, we would say it's out of the money. 4.5, we'd call it at the money because, hey, that's a par bond, right? So the call option starts increasing in value all the way up to, like we go down to 3. This is 130 something. The call option now represents 19.11% of par as opposed to 5.37% of par. So we can see that as the level of rates tend to drop, the value of the call option tends to increase. The value of the straight bond tends to increase, but pay attention here, the value of the callable bond also tends to increase as well, but at a rate slower than the rate at which the straight bond increases because the option takes a bigger and bigger piece the lower and lower we go. Well, let's look at the effect of the changing shape of the yield curve on the value of a callable bond. We've looked at level already, at the changing level of the yield curve. Now we're going to change the shape from upward sloping to flat to downward sloping, and we're going to use a 30-year 4.5% bond, callable at par in 10 years, volatility of 15%. Under those conditions, an upward sloping yield curve from, let's say, 2% to 4% is telling us that the market thinks that the future short-term rates as found in the forward curve are going to be higher in the future. Well, at higher rates, a company's not going to call its bonds. Well, not just a company, but any issuer is not going to call its bonds because it doesn't want to reissue new bonds at a higher rate to extinguish those. And why would it pay par for something that's probably trading at a discount? If it wanted to retire its bonds, go on the open market and buy them. So the option still has value, represents about 8% of par. Again, under these conditions, less likely to be called. But as we cycle through, as the short end of the curve starts to rise to a flat yield curve, and then eventually it rises even higher to a downward sloping yield curve, the downward sloping yield curve is telling us that, hey, in the future, we're market expecting lower rates. So a company or an issuer is more likely to call at lower rates simply because they can reissue also at lower rates, or they can buy at par what would be trading in the market for a premium, more likely to be called. If we have a situation where we have a normal upward sloping yield curve, if we start by assuming a normal upward sloping yield curve, a callable bond issued at par, if we issue one at par, this is a 4.5% callable, so if we issue at par, meaning that the rates are sitting at 4.5%, the call option is said to be out of the money. Well, it's actually at the money, but it's out of the money because it makes no sense to call it. You wouldn't call something for 100 that's trading for 100. There's no motivation. If the volatility were 0%, the bond would never be called. It would never be called because you'd be valuing it purely with an upward sloping yield curve. All right, let's look at the effect the effect on a puttable bond of changes in levels, and then we'll move on to changes in shape. Here we're at the changes in levels. We're going to use a 30-year 3.75% bond, puttable at par in 10 years, assume a volatility of 15%. Now remember, for a puttable bond, it is the value of the straight bond plus the put. So the gray bar, never mind the white for now, let's just focus on the gray, represents the straight bond. We want to make sure we know how to read this chart, right? Rates are going from 3% flat to 5% flat. When rates go up, what happens to the price of a bond? Just a straight bond, it should drop, right? And does it drop? Yes, it does. Okay, so we understand what's going on here. In fact, from 3% to 5%, the value of the straight bond drops 30%. Well, look what happens with the value of the put. The put is in white. The put starts to gain value as interest rates rise. Does that make sense to you? Well, what does a put do? It allows us to put the bond back to the issuer at par. As interest rates rise, the price of a bond drops, so we're more likely to exercise a put that guarantees us par as interest rates rise. So look what happens to the value of the put. The put increases over time. So the puttable bond is the combination of the straight bond plus the value of the put. So the put kind of hedges you against downside risk because the value of the puttable bond, while it drops, only drops 22%, while the value of the straight bond would drop 30%. As rates rise, bond values drop, put increases in value. And the put option is a hedge against rising rates. Not a perfect hedge. I mean, a drop of 22% versus a drop of 30%, it still went down, but not as much. All right, let's look at the effect of the shape of the curve now, going from an upward sloping curve to a flat curve to a downward sloping curve. First, let's get straight in our mind. If we have a put option, we get to put it back to the issuer for 100. Under what interest rate condition would we be more likely to exercise a put? When interest rates are low or when interest rates are high? Well, at low rates, we have high bond prices, so no. At high rates, we have low bond prices, so yes. So we should expect to see the put option with the greatest value under an upward sloping yield curve, and we do. An upward sloping yield curve is saying that the market is anticipating that there'll be higher rates in the future. Higher rates mean lower bond prices. Lower bond prices means a higher probability of using the put, maybe even moving the put into the money. 3.75% coupon. This is upward sloping from 2 to 6. Look at this point here. Only when rates rise above 3.75 would it potentially make sense to use the put. This allows us to go much past 3.75, so the put is roughly about 26% of par. At a flat 4% curve, we're roughly about 7.5% of par because it's in the money, but it's not expected to go any higher or lower than where it is now. And a downward sloping yield curve, we're expected to take us much out of the money. We would not exercise at low rates. At 2%, we wouldn't exercise because we would be dealing with a premium bond. It's better to sell it in the market. Now, as interest rates rise and the price of a bond falls, a holder of a puttable bond, it would be very reluctant to sell the bond for anything less than par because they can always put it at par. So there's a floor to the downside. We're going to see this in one of the later learning objectives, that you'll only get so low as rates go high on the downside simply because, hey, I've got the put option, so my downside is limited to par. All right, let's price out a callable bond. Assuming some volatility now, we're going to bring volatility to 10%. You'll recall we did this earlier. We looked at the straight bond versus a callable bond, but we assumed 0% volatility. Well, let's increase that volatility. So now we have to use a tree. And our par curve, again, 2.5, 3%, 3.5, year 1, year 2, year 3. From that, we can get our spot curve. From that, we get our forward rates. And remember, of course, I said that you can imagine that the tree, all the rates are centered around each of the respective forward rates. There's our volatility. Let's go. Here's our payoffs under all scenarios, 104.25. So if we discount these two back to here at this rate, we will get a value of 98.791. Will not be called. So let's go ahead and add the coupon on so that we can discount it back to the next cell. Here, if we take these two and discount back at 4.5, I can see I'm going to have a discount bond because I got 4.25 under both scenarios and 4.52. And what do I get? I get 99.738. Will not be called, so I can go ahead and add my coupon on to discount that back. Here, it's going to be called because it's the 3.7's below the 4.25, and sure enough, I get a value of 100.526. So I know that this is called, so I don't want to bring that back. I only want to bring back 100, so I'll add my 4.25 on. Let's go to year 1 cells. Take these two totals, add them together, discount by this rate, plus these two totals, add them together, discount by this rate, divide by 2. 99.658 will not be called, so I can go ahead and add the 4.25 on. Here, I'll do the same thing. I'll get a cell value here of 100.922. That will be called, which means I only want to bring back the 100 plus the 4.25. That'll result in a total here of 101.540. So what is the value of the call? Value of the call now, the straight bond was 102.114. This bond is 101.540. So that's 0.574. Versus when we had zero volatility, priced this out earlier, we got 0.407 for the call at volatility of 0%. We got 0.407. So we can see that as volatility increased, we can clearly see the value of the call embedded in this bond has increased. All right, let's make sure that we understand what we're doing here. So let's look at some questions. Assume that volatility is now 15%. We calculated that bond with a volatility of 10%. We got to 101.54. Now we're going to say it's 15%. The new value of the callable bond is. So let's think it through. When volatility increases, the value of the call option increases, so the call option will be worth more. A callable bond is a straight bond minus the call option. So volatility doesn't affect the price of the straight bond. So if the call option is bigger, the callable bond must be less than 101.54. And there's our answer right there. The bond is now callable at 102. Instead of 100, it's now callable at 102. The new value of the callable bond is, and now you would think, well, I have to redo the whole thing again. Well, no, we don't. Did the price at any cell exceed 102? It got to 101.526 and we called it at 100. Then it got to 100.922 and we called it at 100. But it never exceeded 102. And if it doesn't exceed 102, it will never be called, which means it will equal 102.114, the value of the straight bond. Okay, so let's look at a puttable bond now. Pretty much the same thing, except now if the cell has a value below 100, we'll write it up to 100. So we have the same par curve. We're going to assume greater volatility. We got 15% volatility. Here's our forward rate tree. 4.25% bond, puttable at par year 1 and year 2. So let's go. Let's discount these two back at this rate. We are going to get, let's get a good color here that we can see a value. Try that again. A value. There we go. Equal to 98.971. We've done this before. And will this be put? This will be put at 100. So it'll be put at 100, and then we'll add the 4.25 on. Do the same thing here. Remember, we got 99.738. Well, I'm not going to take that. I'm going to put it at 100. Put at 100. I want the full 100. And add the 425 on. Here we got to a value of 100.526. Sorry. 526. We're not going to put that. We can sell it for more, so we'll keep that and we'll add the coupon on. 425. Well, let's calculate our values for this cell. Here we got 100.366. It's not going to be put. Here we get 101.304. That's not going to be put. Go back to the next cell. We get 102.522. Should it be more than the value of the straight bond at 102.114? It should. Because a puttable bond is a straight bond plus an extra benefit for us. We get to put it. So the value of the put is the value of the puttable bond, 102.522, minus the value of the straight bond, 102.114, is 0.408. Versus, you'll recall when we did it at zero volatility, we had 0.0283 at zero volatility. So the higher the volatility, the higher the option value should be. Is that the case here? 0.203 to 0.408? It is the case. All right, let's reinforce that learning. Assume that volatility is now 20%. On that last screen, we calculated the puttable bond at 15% volatility. Now it's 20% volatility. The new value of the puttable bond is, well, let's break it down. What do we know? When volatility increases, the put value increases. Does the put increase or decrease the value of a straight bond? Well, it increases the value of a straight bond, so it should be greater than the last valuation we arrived at, which is 102,522. It should be greater than. There's our answer right there. Let's say the bond is now puttable at 95. In anywhere in that tree, did we come up with a value less than 95? No, we didn't. So we didn't have to write it up to anything. So the value of the bond will be closest to 102.114. Why? Simply because we will not change it. We would make no decision at any node that we wouldn't make had we had a straight bond. We wouldn't be putting it at any part of the node, which means it would be the same as valuing a straight bond. The value of the bond is closest to 102.114. Okay, well, we're going to move away now from the idea of the risk-free or the default risk-free bond into a risky bond. Everything we've done now, we've done the callable and the puttable bonds. I think we get that. We've used the tree. But in using that tree, notice that we really just used the forward rates derived from the spot rates that came from the par curve, the government par curve. Well, you can't use those rates to value let's say, a callable bond from a corporation because there's extra risk involved. So we have to bring two things together that we know, a valuation framework we've done so far and a Z-spread. And this really couldn't be easier. It's not difficult to get through. So we're going to look at something called the option adjusted spread, or OAS. And this extends the valuation framework we've used so far. It extends it to the valuation of risky bonds. By the way, for those who are interested in where this stuff comes from, the option adjusted spread was a proprietary tool for quite a while of Solomon, late 80s, early 90s. They were the king when it came to bonds, and this was developed at their organization, the OAS. The tree that we just did, that was developed at Goldman. And if you're familiar with the Black-Scholes model, the first author, or the first, I wouldn't call author, the first academic on that, Black, he was part of the team that developed the binomial tree valuation that we've just been doing. So this all comes from practice, and it's basically what we're doing here. These are industry standards now. So the option adjusted spread is basically an industry standard. It's common. So how do we do this? Well, we raise the 1-year forward rates derived from the default free benchmark yield curve by a fixed spread, the Z-spread. So you know that tree, the way we do that tree, and we center all of the rates around the forward rates? Well, after you get that tree, what you want to do is you want to raise all of those rates by a constant amount. We're going to do that on the next screen to show you how that's done. And how much do we raise the rates by? What's the size of the Z-spread? Well, what we do is we estimate that spread from the market price of suitable bonds of similar credit quality. So we take our risky bond and we say, well, what's out there? What's close to this? This one is close to this and it has a price of this, so let's try to extract this price from the tree. And we add a certain amount to every discount rate, and we see if we can extract that price. If we can't, we just recalibrate the spread and we try it again. So just to show you how it looks, recall that our bond that we've been using, the 4 1/4 3-year bond. Here's our cash flows on the top. Recall we got the price of 102.114, and here's our discount at the bottom. These are just the default free, that's the spot price, and these are the next two forward rates that we're discounting the cash flows by. If we assumed a 100 basis point Z-spread, look what happens. Every rate goes up by 100 basis points. It's not just that one rate goes up. Every rate goes up by 100 basis points. So our new price would be $99.36. So a comparable a callable government bond at 102.114, a corporate bond with a Z-spread of 100 basis points would be at 99.326. So let me give you an idea of what that would look like. So here's our 3-year 4 1/4 annual callable at par bond, volatility 10%. Now let's assume that this is a risky bond and we want a Z-spread. We can see a comparable selling in the market for 101. So we'll start with a Z-spread of 30 basis points. How would that look in here? we actually just go ahead and add 30 basis points to every single rate. There's some confusion sometimes where we think, well, we take whatever the default rate is in here that we're trying to, let me see if I can, before we get these two rates, and we'll add 30 here and then get these two rates. No, no, no. Whatever tree we get to, before we move it over to the risky bond, we simply add the spread to every single point, every rate along the way. So here's our cash flow at the end, 104, and if we work our way backwards, we'll get to 100.973. Remember, we've added 30 basis points to every rate, right? We get to 100.973 versus 101. We need to get to 101, so we know that we're too high on our z-spread, so we might go down to 29 basis points, do it again, and see where we get. Maybe that's too high as well. We might go to 28, find that that's too low. We go to 28.5, so it is iterative. It is 28.55 basis points. But if you're doing this in a spreadsheet, it's very, very quick. You're not going to do this in a spreadsheet. This is this kind of stuff is programmed into almost every software that you would use out there anyways. So this is just it's an industry standard, so it's just a tool that's programmed into your system. You probably don't need to calculate anything. If you enter the price of a comparable, it'll just tell you what the z-spread would be given what the rates are. Okay, well, let's look at what happens to the option adjusted spread in the face of volatility. It is volatility dependent. You can conceive of the z-spread as being made up of the option adjusted spread minus the option cost. So what happens, now the z-spread will stay constant all the time. As volatility increases, it doesn't make the bond riskier. It makes interest rates riskier, but it doesn't make the bond riskier. It doesn't make the company riskier, so the z-spread would have to stay constant. But if the z-spread is made up of the OAS minus the option cost, as volatility increases, the option cost increases, which means it grabs more of the z-spread, so the OAS has to decrease because this is a constant term. The OAS itself is a constant term. So let's have a look at what that looks like. Take a 5% callable in 3 years. This is a risky callable. 23 years to maturity, priced at 95. We're going to assume a flat yield curve at 4%. And we're going to increase volatility along the bottom. As volatility increases, holding the z-spread constant. That's the important term, right? The z-spread doesn't change just because volatility changes. It's constant. I think it's a credit spread. You can think of it as a credit spread. The OAS, the option adjusted spread, would decline as the option grabs more of the spread. So we know that at higher levels of volatility, the option, the embedded option, becomes more and more valuable. It takes away from the value of the bond because obviously that belongs to the issuer, but it squeezes out the option adjusted spread out of the z-spread as well. So we have it declining at very high levels of volatility. We can see the OAS is very, very small because you must keep a constant z-spread. So you'll recall in level 1 we were introduced to two measures of duration, well, three, but really two, the modified duration and the effective duration. And the difference between modified and effective was just in the denominator, the change in yield versus a change in curve. And it's difficult sometimes for students when they look at that to say, well, what's the difference between them? If the curve changes, doesn't the yield change as well? Wouldn't they just be the same thing? And it's hard to see the difference until we get to here and we realize, I see now. For any straight bond, modified duration, there you go, off you go. But once you get to bonds with embedded options, well, cash flows change. So your duration measure is not going to be the same as it would be with a straight bond because it may be called. So for bonds with embedded options, the only appropriate measure is effective duration. And effective duration, just to refresh your memory, looks like this. PV given a drop in rates minus the present value given a rise in rates divided by 2 times the change in the curve times P naught, the present price or the current price we observe. So to arrive at effective duration for a callable bond, or a risky callable bond, let's go that way, is a little trickier here. Given our current price, we calculate an option adjusted spread given some level of volatility. So we have our option adjusted spread given what we observe on P naught. Then we're going to shift the curve down. We're going to generate a new tree. Oh yes, you have to generate a new tree, because if the curve goes down, remember, effective duration is for a parallel shift in the curve. Key rate duration is for a shift in one of the rates, but if we're doing effective duration, that's a parallel shift. So that whole curve comes down. Well, if the curve comes down, you need new rates on that tree. So you have to generate a new tree. Then you must revalue the bond using the same OAS that you developed up here, that you found up here. Because remember, we got to keep that constant. If rates change, the option adjusted spread won't change. The Z spread will stay constant, right? So you'll use the same one from one above. That'll give you PV negative. Then do the same thing again. Shift the curve up and repeat this process. Generate a new tree, revalue the bond using the same OAS, and you'll get PV plus. That's all you need to do. I say that's all. That's actually quite a laborious process if you're going to do it on pen and paper, and imagine doing it with a 10-year callable. So you'd never actually, again, I've said this before, you're never going to actually sit down with a spreadsheet and do this in your professional career. You're going to have that available to you through numerous different software packages that you'll use, or vendor packages that you'll use. But you better know what you're looking at. You better know what it means, and you better know the logic in behind it, because you need to make some decisions sometimes on a process within the algorithm that you better understand the effect on the price later on. So that's why we do this. Not that you're going to do the math, but doing 3-year problems, those are small to do, but it gives you the idea of what's going on behind the scenes, right? Let's take a 3-year, 4.25% callable bond. Volatility 10%. We've done this one before. Price of 101, option adjusted spread of 28.55. And let's shift the curve down 30 basis points, revalue the bond using the same OAS of 28.55. PV negative is 101.599. Do it to the upside, we get 100.407. So let's calculate our effective duration at this point. This is fairly straightforward. In fact, this is the easy part, right? 101.599 minus 100.407 over 2 times the change in yield times the current price equals 1.97. What does this mean? What does this mean? It means the same thing it does for all effective duration measures. 100 basis point increase in rates is a drop of 1.97% in bond price. Drop of 1.97% in bond price. For the majority of problems that you come across, the easy part is the formula. That's the easy part. So I look at this, I go, okay, well there it is. These are the things I need. I need P naught, PV negative, PV plus, change in curve. And then off you go. The hard part is, where do I get these now? P naught I can observe, the change in curve, well I'm going to manipulate that. My denominator's fairly easy to get. Where do I get these two? Well, PV minus. Well, what is PV minus? Then you go to that and you look at that formula. Well, where do I get that input? The easiest part of finance, most people think this is the hardest part of finance, are all the formulas. No. That's the easiest part of finance, because the formula tells you exactly what you need. These are the variables that you need. If you can find these variables, I'll give you the answer. The hard part in finance is finding the variables. The PV negative, the PV plus, is going out and actually getting those. That's the hard part, the process of getting it. The formula, well, that's fairly straightforward. Once I have all my inputs, the formula, anybody in grade 3 can solve the formula just by putting in the variables, right? All right, let's look at the relationship between the callable and puttable bond and the straight bond in terms of duration. The effective duration of a callable puttable bond is usually less, is always less than the effective duration of a straight bond. A better way to say that is the effective duration of a callable or puttable bond can never be more than the effective duration of a straight bond, but it can be very, very, very close as to be pretty much equal. So we could add an extra line here. Instead of an equal sign, we could add one of these signs saying less than or almost equal to the effective duration of a straight bond. So let's have a look at what this looks like. let's say here's our yield curve along the bottom, and let's say this is the 0 point. We're going to shift it up by 50, 100, 150, 200 basis points, and we're going to shift it down by 50, 100, 150, and 200 basis. So this is a downward shift. This is an upward shift. Let's look at our option-free bond. Here it is right here. So as the yield curve is shifting upwards, look what's happening to the option-free bond. The duration is dropping over time. This is a 10-year bond, by the way. So it is dropping as interest rates are increasing. Well, what happens to the duration of a callable and puttable bond? It follows a completely different path. Let's look at our put option, our puttable bond first. At very low rates, the put is out of the money. At very low rates, simply because the price is high, you're not going to put the bond. It's at very low rates. So if you're not going to put the bond, think about doing it in your tree as you're moving backwards in your tree. If you never put the bond, you will eventually arrive at a price for that bond that's equal to the price of the straight bond, or pretty close to the price of the straight bond. At low rates, the put is out of the money, so the effective duration of the puttable bond is pretty much the same as the effective duration of a straight bond at low rates. But once the put starts moving into the money, look what happens. Bang! Look at what happens to duration. It comes all the way down. The put option is in the money because now you can put it at par. So your duration is right until the next call date. If it's a Bermuda call and it's annual, your duration is just the very next coupon date, perhaps, or the very next payment. But the puttable bond drops considerably, and its duration drops right off because now, well, the cash flows can change. The moment I put it, it's over. There we go. I'm done. I put it at par. For a callable bond, it's another way around. At very high rates, the call is out of the money because the price is very, very low. The company's not going to call for 100 what it could buy for 95, let's say. So the effective duration of the callable bond is pretty much the same as the effective duration of a straight bond at very high rates. Once rates start dropping, the price of the bond starts increasing, and it's also better for the company to reissue at lower rates. Look what happens to the duration of that bond. It drops down almost to zero. The call option is in the money. It can be called at par. Okay, let's look at one-sided and key rate duration. We've seen key rate duration at level 1. One-sided, that's a new term, not new to level 2, but new as you're coming into level 2. And the best way to explain one-sided duration and the information that it has is to have a look at a straight bond versus a callable and puttable bond in graphical form. So let's plot our rates and our price, and we've seen this in level 1. Here is the shape of what the price of a straight bond would act like, and right below it is the price of the callable bond. Does that make sense that the callable bond price should be below the straight bond? Yes, we've said that. The callable bond is lower than the straight bond by the value of the call option. So the lower interest rates go, the wider the spread between those two prices because of the call option, right? So at very high rates, the callable bond has a path that would follow very closely to the straight bond. But as interest rates continue to decrease, notice what happens to the callable bond, right? It's pulled towards par. Limited upside potential when the call is in the money. So if we were looking at a measure of duration, and let's say we were looking at a measure right here, and we extended that down to here, and let's say that we change rates by an equal amount on each side to get PV negative and PV plus, and we would end up here on the curve, and we would end up here. Well, you can see right away the difference between the two. They're not symmetrical at all. In fact, there's very limited upside. So the shape or the slope of the curve above the point, or if we think about it in terms of the horizontal, below the point is much lower than the slope of the curve above that point, above that interest rate point. You look at the put. As interest rates start increasing, the price of the bond decreases, but for the put, the price will flatten out pretty close to wherever par is. So you can see that the slope of the curve here is very different. If we take a given point here, the slope of the curve here is much lower than the slope of the curve on this side. So you're going to end up with asymmetrical measures of duration. So you have limited downside potential when the put is in the money. The price sensitivity of bonds with embedded options is not symmetrical to equal increases and decreases in the change of the curve. So let's have a look at a couple of examples and see how that plays out. We'll use a 5-year 4.25 annual bond, callable at par, 4% flat curve with a volatility of 15%. And we'll increase the curve by 30 basis points and decrease the curve by 30 basis points. We'll look at the value of the bond and the duration measure that we would use. An increase of the bond of 30 basis points, it changes the value of the bond from 99.75 to 99.17. We'll use a one-sided duration, we get 1.94. If we shift the curve downwards by 30 basis points, the value of the bond is capped at 100 because we've got 4.25%. You got a 4% flat curve. 4.25 minus 30 basis points is 3.95. We're in the money. The call option is in the money, so the risk of being called is there. And if it's going to be called, no one's going to pay more than 100 for it. That's your upside potential on the price of the bond. So your one-sided duration here is 0.84, significantly lower. So your upside potential here at 0.84, you have limited upside, and your duration measure tells you that, but you have much greater risk on the downside. Notice that your duration measure is more than double. More sensitive to interest rate increases. If we look at a puttable bond, 4.1% annual bond, puttable at par, 4% flat curve, volatility 15%. 4.1, we're going to increase it by 30 and decrease it by 30. So if we go from 4.1 to 4.4%, what happens to the price of the bond? Well, the price of the bond would decrease, right? But look what happens. It stops at 100. Why? Because it can always be put back for 100. So why would you sell in the market something for 99 and change when you could easily put it back, right? So the appropriate measure in this situation is a one-sided duration measure, 1.49. But a drop in rates sends the price up, where it go from 100.45 to 101.81. Using a one-sided duration here, we get 4.51. So notice that we have nice downside protection. The value of the bond drops by 1.49%, but upside it increases by 4.51%. It is more sensitive to interest rate declines. So the callable bond will be more sensitive to interest rate increases. The puttable bond will be more sensitive to interest rate declines. Our one-sided duration measure captures that, but our effective duration does not. And one more thing before we go. If you're interested in, well, how did you actually calculate the one-sided duration? And this is the thing I don't like about these CFA textbooks, is that they sometimes just leave things out that might just close the gap. That one extra sentence would make all the difference sometimes, right? That if you're going to give me the solutions to something, at least give me the method you got to get there. Well, in your effective duration measure, let's look at the numerator. We know it's PV minus PV plus. So if we look at that in terms of a chart, and let's say that this is P naught on the side, this is our R, this is our price, this is P naught. PV plus means we changed our rates, we would get a lower price. PV minus means we lowered our rates. If you follow along on the curve, we get a higher price. This is really just the difference between it. It's just the change, the price differential between this. So if you want a one-sided duration measure for PV minus, once you lower the rates, you get a higher rate. Here's your PV minus. You just compare it with the original price, and your PV plus is the lower point. You're just breaking up the full difference between the two with P naught in the middle. So that's basically how your numerator would change, is you wouldn't be using PV minus minus PV plus. You'd be using PV minus minus P naught and P naught minus PV plus, and there you would get your sides, your two sides. All right, let's move on to key rate duration. Effective duration, as I said right at the very beginning when we started with duration, is for a parallel shift in the benchmark yield curve. So the question arises that, well, hang on now, that's for levels. We know that there's level, there's steepness, there's curvature, right? And that's just a change in level. What happens if there was just a change in the shape of the curve? How would bond value change if only the 2-year moved up by 5 basis points? That's a valid question. So we use something called key rate duration or partial duration. We'll see why it's called partial duration in a second here. But key rate duration help identify shaping risks, steepening and flattening. So if we take all of our key rates along the yield curve, all of our key rates, and we calculated a key rate duration for every single rate along the yield curve and added them up, we get effective duration. That's why it's called partial duration, because every key rate duration along the curve, if you add them all up, you will get effective duration for a given change in the curve at each key rate. The valuation procedure and formula are identical to full effective duration. So the way we calculate a particular key rate duration is we just change that particular one. We do a PV plus, PV minus, and we calculate it the same way, but it is only for that particular rate. Well, let's move on to looking at the difference in key rate durations when we move away from an option-free bond towards a callable bond and a puttable bond, and let's see if we can make any sense out of this. And I will say that this section over the years has been one of the most frustrating sections for being the most poorly described in the text, and it's hard to find some satisfaction out of this section or in other textbooks that talk about this, because they just seem to make these conceptual leaps from that's the way it is and that's the way you should know it. So I'm going to try to see if I can't prove to you some of the statements that have been made using a spreadsheet to show you how we get these rates. So let's look at this first chart up here. Let's make sure we know what we're looking at. The bond that this is representing is a 10-year option-free bond. This is a straight bond, right? And we're assuming a 4% flat curve. So what do we mean when we say 4% flat? That means every par rate is 4%. The 1-year par, the 2-year par, the 3-year, all the way to the 10-year par. Which means all of the spot rates are 10%, which means all of the forward rates, all of the spot rates are 4%, and all of the forward rates are 4%. It must hold. Do the math. Start with 10 par yields at 4% and derive the spot rates from them. You'll get 4%. Derive the forward curves from them. You'll get 4. I don't think that is a difficult thing to get our heads around at this point. Great. Let's start with the coupon bond. This is the coupon, the rates on the coupon. Given a 4% flat curve, we have a 4% coupon, it shouldn't surprise us that we have a par bond. And what we're going to do is we're going to look at the different key rate durations. So we'll change the 2-year and see what happens. Change the 3-year, see what happens. Change the 5, see what happens. Change the 10. Now, we want to see what happens to the overall price of the bond. When we look at this one, we're seeing that the only rate that matters is the 10-year. That changing any other key rate will have absolutely no effect. So duration for this par bond is determined entirely by the 10-year. However, when we move off of the 4-year to the 2-year or the to the 2% coupon or the 6% coupon, suddenly the key rates do matter. What gives? And the textbook simply just says, well, that's just the way it is. That if you have a par bond and you change any of the key rates, none of them will matter except the maturity matching par yield, which is the 10-year. And I find that unsatisfactory. I'm left wondering, but why? Why is that? Please explain that to me. Show me why that is the case, because in my head I can see changing a 3-year rate would then cascade into other rates changing, but why would it only result in this at a 4% coupon, but suddenly we have something different when we're off the coupon? Let me show you how that's done. All right, so the first thing we have to understand, which is just a terrible way to do it, is the curriculum, when it talks about a change in the curve, is talking about a change in the par rate, not in the spot rate, but in the par rate. So if you were trying to figure out how is it, and you were changing the spot rate and you were finding that no, I can't replicate that table. Well, you're right, you can't if you change the spot rate. You got to change the par rate. So Let's take our years, year 1 through year 10, and we started off with a 4% flat yield curve, right? So there's our force. All we're going to do right now is we're going to change the 5-year. We're just going to bump that up 100 basis points. That's all, and we're going to see what happens. When we bump this up, we have to recalculate our spot rates. Well, for year 1 to year 4, they'll still stay 4%, but for R5, since this is a par rate now, what does a par rate mean? It means that it equals 100, right? It equals 100. So our cash flows are along the top. Notice it's not a 4, it's a 5 along the top. But look at what we're discounting by. The 1-period spot rate, the 2-period spot rate, the 3, etc. And then we have our missing variable, x5. Well, when we solve for that, we get 1.05107. So 5.107 becomes the new 5-year spot rate. Well, let's move over to the 6-year par now. Now, that stayed, all we changed was the 5-year, right? Remember, key rate, we're only changing one rate. So the rest of them are still at 4. So how do we get the spot rate for R6? Well, it's 4, 4, 4, 4, 4, 104, divided by all of the spot rates, 104, 104 squared, etc. Except now we're discounting this one by 1.05107, which is the 5-year, and we're going to solve for X6. We get 1.03964. 39.64. So there's our 6-year spot rate. Let's go to the 7-year. And remember now, this is still at 4%. So how do we find the 7-year spot rate? We do the same thing. We discount all of our 4s and our 104 by the exact spot rates. Look at this one as being discounted by 1.05107. This one by 1.0396, whatever, to the 6. And we solve for x to the 7. We get 1.03969. Look what's going on here. These are not all the same, right? 3.964, 3.969, 3.973, 976, 979. So what happens is the year 5 coupon, when we go to a coupon paying bond, let's say it pays a 6% coupon, the year 5 coupon will be discounted by a higher amount, thereby making that value lower, but every subsequent coupon will be discounted by a lower amount than the original 4%. So the change cascades down from it doesn't just correct in the next year. You got year 6, year 7, year 8, year 9, year 10. Now, if you had assumed that the change didn't happen at the par rate but happened at the spot rate, you'd be changing your forward rates, and you'd find that, hang on, when I changed the year 5 rate, it reverses back in year 6, and then 7, 8, 9, 10 are all back to 4%. What gives? The book is not very clear on this. It should have put in big, big, fat, bold letters. The change in the curve is the change in the par rate. From the par rate, you get the spot. From the spot, you get the forward. Now, you need the forward rates to price the callable and the puttable bonds. You can't get the right forward rates unless you have the right spot curve. You won't know about the right spot curve unless you recognize that, oh, they're talking about changing the par rate, not the spot rate. You would think it would be the spot rate, but it's not. It's the par rate. Let's have a look at this in a spreadsheet just to really make the point now. Okay, I didn't bother making a really nice looking spreadsheet. I just wanted to make my point here. So let's say here's our years, year 1 through year 10. Here's our par curve, 4, 4, 4. Notice I changed this to 5, 4, 4, 4, 4. Here are all the spot rates we had recalculated. And here is, using this new spot rate after we've changed, here is the discounting for a coupon of 2. And here is the original curve, 104, and a discounting of 2. What I want to do is I want to put 4 in to make it the coupon at 4%. Again. So let's have a look at what happens to the coupon at 4%. Under our original term, look at all of our par rates, which are all of our spot rates, which are all of our forward rates, are all equal at 104. If I discount this $4 by 104, this $4 by 104 squared, this one by 104 cubed, etc., all the way down, I get 100. When I change the 5-year rate from 4 to 5%, look at the spot rates change, and I discount everything by the appropriate spot rates, look what I get, 100. So by changing this par rate, the 5-year par rate, from 4% to 5%, I discount this. Look, when I discount at 4%, this is 3.2877. Here I'm getting 3.11. I get a lower number. But look what happens after. Each one is a little bit higher than it is here. It still comes to 100. So this shows you that if the coupon is 4% and the 10-year par rate is 4%, changing any other par rate in there cancels out by the time you get to the 10-year. If the coupon is the same as the 10-year par rate, in other words, if we start with a par bond, we'll end with a par bond. Now, let's change the coupon to 2%. I'll change this one to 2 and this one to 2. So if I look at the original situation on the coupon here, what is the price? 83.778. 83.778. Now I change the 5-year. Again, here, this is the change. What do we get? 83.84. These are not the same any longer. 83.778 to 83.84. Let's change the coupon all the way down to 0. Make it a 0 coupon bond. We would think, well, it shouldn't change anything, eh? Well, have a look at this. Look what's interesting here. This was 6755. We increased the 5-year spot. We increased, the 5-year par. We increased it. So on a naive thinking, you would think, well, if one of the rates go up, even if just one of the rates go up, you're discounting back by your denominator increases, you should end up with a lower amount. What do we get? 67.69. Why? Because the only cash flow in a 0 coupon bond that matters is the last cash flow. Here we're discounting this cash flow at 1.04. Here, because this rate pushed up this spot, which then lowered all the others, we're now discounting the full 104 here by 1.0397, not 1.04. So it actually ends up being a higher value. So on a flat yield curve of 4%, a 10-year 0 coupon bond, if the 5-year rate, only the 5-year rate goes up by 100 basis points, the 0 coupon bond actually increases in price because of the mathematical relationship going from the par to the spot. Look what happens there. I know it's not that intuitive. When you look at the chart, you're left wondering, why? Why? And the explanation is always, well, it's just a mathematical necessity of the relationship between the par, the spot, and the forward rates, and you're still left wondering, but it doesn't it seems to go against all intuition that I have about bond pricing. Well, it does and it doesn't. Once you realize that we're starting at the par and it spills over into the spot, and since the spot is a mathematical result of the par curve, notice what happens in the final year. So let's change this coupon now to 10% coupon, and let's see what we get. Under an original scenario, we have 148.665. Now we have 148.45. Notice there is a change in price. Again, let's go back to that 4% coupon, 100, 100. So if you were having difficulty replicating that table, you can now replicate that table and you have deeper understanding than just taking the book's word for it that it's a mathematical necessity. Just remember it and move on. Now we can move on. Well, hopefully that cleared a lot of stuff up, and now this table might be a little bit more easy to digest now that we understand what all these things are. So let's get to the point that we want to do now. Now that we understand what we're looking at, let's look at a callable bond. This table down here comes from a 30-year bond. This just goes up to a 10-year, but this goes to a 30-year bond. It's callable in 10 years. Volatility of 15%, 4% flat yield curve. I'm not going to go through the derivation of how these came about because this requires a tree and lots of work to get to. You certainly wouldn't, especially with a 10-year. Well, this is a 30-year, so I'm not going to do it. Now that we understand how these numbers came about, just take my word for this, please. All right, so all we have to do is figure out under what scenario will this bond be called. We got a 4% flat yield curve. If it's paying a 2% coupon, would the bond be called? Why would the company call a bond that has a 2% coupon when the current rate is 4%? It would have to reissue at 4. So it's not likely to be called down here, not likely. But if it had a 10% coupon and rates were now 4%, it is very likely to be called. And since it's very likely to be called, look what happens. It starts acting like a 10-year straight bond. Because if it's callable in 10 years, it will have a duration of what a 10-year non-callable will be. Look at what we have here for the price, 149.05, 148.95. Look at the total duration, 7.07 versus 7.14. All of the key rate durations are the same, except the 30-year will still keep a little tiny bit, but the 10-year is the major contributor to duration. By the way, if you take the 9.81, just out of an example, take all this column where it says total, and you add across all of the key rate durations, you'll get total duration. It is the sum of all the individual durations. So anyways, that's important. The conclusion that we get here is if the bond is callable and if the call is in the money, the bond will act like a straight bond at first call. So where is first call here? It's callable in 10 years. It's very in the money. So it will act like a straight 10-year bond as far as duration is concerned. And we see that it does. All right, let's look at the 30-year puttable bond in relation to the table for the 10-year option-free bond. This is a 30-year puttable in 10 years, 4% flat, volatility of 15. Under what scenario will this bond likely be put? At 10% coupon? Probably not, because you put it at 10%. What are you gonna? The only thing you can rebuy is at 4%, so it's not going to be put. It's unlikely to be put down here. As such, look at the 30-year hogs most of the duration. If total duration is 14.65, the 30-year has the big impact because that's the big cash flow, right? Well, at 2%, it is likely to be put. Because it's got a price of 83.89, you can put it at par. You can put it at 100, and you can reinvest that money that's getting 4%. So it'll behave like a 10-year option-free bond with a 2% coupon. So look at the 2% coupon, 30-year callable. First call is 10 years. Look at a 10-year straight bond, no call option, just 10-year straight bond with the same coupon, 83.89, 83.65. Total duration 924.883. Look at all the key rate durations. Very, very close to the same thing. The 10-year 8.98, 9.37. So we can see the relationship between first call, how the duration as far as first call is concerned, and how it would behave if it's in the money. Basically, pretty much like a straight bond with the same tenor as the callable bond to first call. All right, well, with effective duration behind us, let's look at the second part of this measure, effective convexity. And you'll recall we use effective convexity because duration is a linear approximation of price changes, and the shape of the curve, the bond curve, when you plot price against changes in rates, is a convex shape. So you'll recall effective convexity is this formula here, PV minus plus PV plus minus 2 times PV naught over the change in the curve squared times PV naught. Now, as far as effective convexity is concerned, let's look at the option-free bond, the puttable bond, and the callable bond. For the option-free bond, let's say that we're looking at a point right here before our interest rate change upwards and our interest change downwards. You'll notice that no matter where on the curve we land, effective convexity for an option-free bond is always positive, always low and positive convexity, always. For the puttable bond, what we have here is pretty much the same thing, but look what happens over here. The puttable bond tends to level out. So if we were looking at a rate change for a puttable bond that's in the money, let's say right here, you can imagine the line across here looking like this, so that you have a much higher convexity number to the downside when rates are dropping than when rates are increasing. But for the puttable bond, the takeaway here is convexity is always positive. So for the option-free bond and for the puttable bond, convexity is always positive. For the callable bond, that's not the case. When the call is out of the money, we have positive convexity because the callable bond will act like the straight bond. However, it is drawn to par as interest rates drop. The price of the bond is drawn to par, so that you end up with negative convexity when the call is near the money and entering into the money. So when the call is near the money, effective convexity drops to below 0 simply because the bond is capped at call prices. Here we have, for the puttable, you have positive convexity all the time because the bond itself is floored at the put price, so it doesn't keep extending downwards. And because we have true convexity all the way through the curve here, we have positive convexity each time. Not only that, the price increase with a drop in the curve will be greater than the price decrease with an equal increase in the curve, so that you have more sensitivity with rates dropping than with rates increasing. Same thing with the puttable bond. There's more sensitivity when rates are decreasing than when rates are increasing, because as they increase, well, the puttable bond will get floored at that price. So there we go. Only one instance of negative convexity, and that is the callable bond at low rates when we get near the money for the callable bond. So let's have a look at a callable and puttable bond, because our learning objective here is not so much to calculate and interpret, but it's just to compare. And we've done a lot on the last screen in comparing effective convexity of the straight bond, the puttable bond, and the callable bond. Let's just see if we can calculate some of these things. So we have a 3-year, 3.75% annual bond. The X bond is callable with these features. Y is puttable with these features. We should expect the puttable bond to be priced higher than the callable, and it is. We've already gone ahead and calculated PV negative, PV plus for a 30 basis point change in the curve, 30 up, 30 down. Here's what we get: effective duration and effective convexity of X and Y. So let's begin with bond X here. What do we have? 101.194 minus 99.86 over 2.003. 100.594 will give us 2.21. Now let's do effective convexity for this bond. We have 101.194 plus 99.86 minus 2 times 100.594 over 0.003 squared times 100.594 will give us a negative 0.134 over 0.0009, which gives us negative 148. So we see that we have a negative result here, which is in line with what a callable bond can have. It can have negative convexity at low rates. What about the puttable bond? Should we get positive or negative convexity even before we calculate it? We can never get negative convexity. For a straight bond, you'll never get negative. For a puttable bond, you'll never get negative. And for the callable bond at low rates, when rates are near the 3.75 or below, we can get that. So let's have a look at what we can get for Y here. And I'm not going to go ahead and plug in all the numbers. I think you can do that. Again, that's sort of the juvenile thing to do at this point. It's more or less the comparison that we want to make at this point so that we can answer some questions where we're not really just plugging numbers into a formula, right? If you put everything into Y, you will get 1.58. And if you do the convexity number for Y, you'll get 160.093. If you have my video notes, you'll see that I've put in all the numbers. So if you're following along with the video notes, you can see all the numbers are in. So notice that we get positive convexity. We have a puttable bond. Should we get positive convexity? Yes, we should. All right, let's make sure we understand what we've just done and that we understand all the relationships here. X, callable bond. Y, puttable bond. Same one we just did. Let's answer some questions about that. When interest rates rise, the effective duration of A, bond X, shortens. Let's deal with that. Does it? If interest rates rise, the price of bond X falls. But there's no floor on bond X. There's a ceiling, but there's no floor. So it would not shorten duration. We can certainly say that. It would not shorten duration. So we can say that that is wrong. Now, why am I saying that it doesn't necessarily lengthen duration? Because we don't know where we're starting from. If we're already out of the money if we're already out of the money and interest rates rise, we're moving even more out of the money. So if we're out of the money, a callable bond will act like a straight bond. So if we move even more out of the money, it's not going to, we can't say that it'll lengthen duration, because when we get to answer C, you'll see what I mean when we say that, but we can't really say that it'll lengthen duration, but we certainly know that it won't shorten duration, so we can say that that's wrong. A is wrong. What about bond Y? As interest rates rise, the price falls, but bond Y is floored at par, or floored at the put price. So it doesn't necessarily drop. In fact, it moves closer to being put. The probability of being put increases, which means it will dramatically shorten duration, because you can put it at the next put date. So bond Y is true. Let's look at bond C. The underlying option-free bond corresponding to bond X lengthens. So let's take X and let's not make it callable. Let's make it just a straight bond, and let's raise interest rates. Is it necessarily true that the option-free bond corresponding to bond X lengthens? Well, for an option-free bond, we've seen this before when we look at effective duration. We had a chart before where we compared the callable and the puttable, and we noticed that for a straight bond, effective duration kind of looks like this. You had one bond that looks like this, another. You remember that chart. For an option-free bond, changes in the rates have very little effect on duration, so we couldn't really say that it lengthens or shortens. It's a small change. It could lengthen or it could shorten. This is a one-sided statement that it lengthens. Well, we don't know, but we certainly know B. B is the more true one. When the option embedded in bond Y is in the money, let's see, bond Y is puttable. When the option embedded in bond Y is in the money, the one-sided durations most likely show that the bond is more sensitive to a decrease in interest rates, more sensitive to an increase in interest rates, or equally sensitive. Well, what happens when, for a puttable bond, what happens when interest rates increase? When interest rates increase, the price of the bond drops, but not for a puttable bond. So we can say that it's not that sensitive to an increase in interest rates, which means it cannot be equally sensitive to both, which means by default it must be more sensitive to a decrease in interest rates. And that makes sense, because as interest rates go down, prices go up. There's no ceiling on the puttable bond. There's only a floor. All right, the price of bond X is affected. A, only by a shift in the 1-year par rate. B, only by a shift in the 3-year par rate. Or C, by all par rate shifts. Well, we saw that the coupon on X was 3.75%. We had already done that one. Let's make a note of that so that we know. The coupon was 3.75%. And the price of this bond at the time, when we looked at it, was 100.594. Is this a par bond? This is not a par bond. So since it's not a par bond, it's going to be affected by all par rate shifts. If this were at 100, this were 3.75, and this were at 100. Remember, we've been through this before, that whenever you shift one rate, another one has to compensate for it. There'd be no change in a par bond, but this is not a par bond, so it will be affected by all par rate shifts. The effective convexity of bond X cannot be negative. It's a callable bond. Can a callable bond have negative convexity? Yes, it can. So the effectivity of it cannot be negative. We can get rid of that. Yes, it can be negative. The effective convexity of bond X turns negative when the embedded option is near the money. Yes. Turns negative when the embedded option moves out of the money. No, it turns positive. Again, there's what the callable bond would look like. So if we it's a terrible diagram, but if we took an interest rate change, this is moving out of the money, you can see that we would move from a negative to a positive situation. All right, which of the following statements is most accurate? A, bond Y exhibits negative convexity. Bond Y is a puttable bond. Remember, straight bonds, puttable bonds, positive convexity only. We can get rid of A. What's our next statement? For a given decline in the interest rate, Bond X has less upside potential than bond Y. Well, that makes sense. Remember, bond X is a callable bond. It's capped, which means for a given decline in the interest rate, bond X has less upside. That is true. Let's just look at C. The underlying option-free bond corresponding to bond Y exhibits negative convexity. Straight bonds have positive convexity only. We know that is wrong. By default, we only have one answer, which we knew is B. We are on LOSM. Our keyword here is to calculate. Calculate the value of a capped or floored floating rate bond. And this requires just a little bit of extra work, but it's not really that difficult. So let's go through what a cap and a floor is. A cap provision protects the coupon rate from increasing above some specified maximum rate. This protects the issuer. Protects the issuer from rising rates, so it's an option that benefits the issuer. So the value of a capped floater will equal the value of a straight bond minus the value of the embedded cap. We should find that the price we recover is actually lower. So let's have an example here. 4.5% cap, a 3-year floater in arrears. This is the regular tree that we've been working with. For our payoffs at the end, it's going to be slightly different. We're not going to have a latticed effect here. We're going to have something like this. And on this arm, since this is the rate here, the coupon here would be 105.5258. And same with here, 105.5258. Here we would have 104.5242 and 104.5242. And down here we have 103.7041. Now, here's where we got to do a little bit of work. We have a capped floater at 4.5, so we cannot have this. We cannot have this. We cannot have this, and we cannot have this. Both of these turn to 104.50. Both of these turn to 104.50, but this one is fine. So we just discount back the 104.5 back to this point in time, and that will give us a value of 99.028. Now, we're discounting the 104.5 at the rate. We're discounting it at that rate. We just can't have that coupon. So we cap the coupon, but the rate is still the discount rate. And if we add this coupon on, that brings us to 102.8975. We don't have to do anything here because the rate is below 4.5%. Here we'll discount the 104.5 back at this rate. We'll end up with a value of 99.977. And we can add this coupon back on, and we will get 103.48465. That's if we take this path. If we take this path, then we add this coupon on, that would give us a rate of 103.1451. So depending on which path we got to this rate, we'll have a different coupon. And here we discount this back at this rate. It's easy to see that we'll have a value of 100. If we add the coupon on, it will get to 103.1681. We'll take these two, this rate here and this rate here, and discount it back at 3.8695. Gives us a value of 99.521. Add the coupon on, we get 102.021. And discount this rate and this rate, or these two prices back, sorry, at this rate will give us a value of 99.989. Add the coupon on, we get 102.489. Discount this and this at 2.5, and we get a value of 99.761. Not 100.761. So we can easily find the value of the embedded cap by taking 100 minus the value of the cap floater is 99.761 equals 100 minus whatever it takes to get us to this, which looks like it's 0.239. All right, we'll look at the floor now. A floor presents a coupon from decreasing below some specified minimum rate. It protects the investor, so it has value for the investor. It's an investor option. So the value of the floored floater will equal the value of the straight bond plus the value of the embedded floor. So let's look at our example again. This time we're going to put a 3.5% floor, 3-year floater in arrears, and let's draw out our payoffs in year 3. Here we will have 105.5258 on both arms, 105.5258. Those are fine. 104.5242 and 104.5242. Those are fine. And 103.7041, 103.7041. Those are fine. You will find that in caps, the further out you go, the more you have to cap your rates. You will find in floaters that the closer in you get, the more you'll have to floor your rate. So our final tree is fine. We should retrieve 100 in every scenario. Add the next rate on. This will give us 103.8695. Is it above 3.5? Yes, it is. And we'll do the same here, 103.8695. Here we have 3.1681. So if we add that on, 1681, we'll get 103.1681, and that simply won't work. We have to get rid of this, we have to get rid of this, and we'll add 3.5 on. So this turns to 103.50, as does this, 103.50. Let's recover our prices here. Well, the 3.8695 didn't change, so our value here will be 100. We'll add the 2.5 on, we'll get 102.5. Here, we're discounting 103.5 by 3.1681. That will give us a value of 100.322. Add our 250 on, we get to 102.822. Well, we got a problem here, right? We added 250 on. We have a floor of 350, so we get rid of this and turn this into 103.50. And we get rid of this and we add 350 onto the 100.322. That'll give us 103.822. Discount these two back to here, and we will get a value of 101.133. So the value of the floored floater at 101.133 is the value of the straight bond at 100 plus the value of the embedded floor at 1.133. All right, so convertible bonds. This is the last topic we have to cover. We have a couple learning objectives here. And we've seen convertible bonds before at level 1, but let's just briefly make sure that we have the language down. It is a hybrid security. You can think of it as a straight bond plus a call option on the common stock. The holder has the right, not an obligation now, but the right to convert debt to equity during a conversion period at a conversion price. And we'll get into these terms on the next screen. The issuer, for issuing a convertible bond, gets away with paying a lower coupon because the issuer is delivering value, that call option on the common stock. That's not the issuer call option. That is the holder's call option on the common stock. It's like having a puttable bond, except now they can put it for stock at a specific conversion price that has value for the holder. The issuer can pay a lower coupon, lower financing costs, lower cost of debt. If it's converted, here's another benefit, no principal repayment. However, if it is converted, there is a dilution effect. If it is not converted, the issuer must pay back the principal or roll over the debt, and the bondholder underperforms. Because if the call option remains out of the money for the entire period, the holder basically just got a lower coupon than they could have otherwise. Ouch! Sorry about that. For those of you who are watching the videos in the dark, this screen just got really bright and probably you had to squint your eyes a little bit. But I just did a screen capture of one of the text pages for this one. It's easier than writing all this stuff out. Here's some excerpts from the bond, from a typical convertible bond offering, and we have everything we need to know here. I'll point out the important things. Our issue date is April 3rd, 2012. It's due April 3rd, 2017. We got a 5-year convertible bond. First thing I want to do is draw your attention all the way down here to the conversion period. Notice that it's 4 years and 10 months. A 5-year bond and the conversion period's 4 years, 10 months. You can pretty much start to convert it almost right away. Look at the date. The 3rd of May 2012 is 1 month after it's issued, but you have to stop about a month before it's due. And this is just to settle out. You know, from the time that the bond is issued to it's distributed and settled and everyone's paid, they figure, well, 30 days is enough time for that. And then to stop the conversion 30 days before the payment of the bond, simply just to settle out the transfer of any stock that has to happen at that time. So the conversion period for a convertible bond lasts pretty much the whole period of time. So it's almost like an American call option in that respect, because it's there, it's ongoing, right? The initial conversion price, this is important, $6 per share. So in other words, the holder of this bond, we can see that it's 100% par denominated into bonds of $100,000 each. So you need a minimum of $100,000 to buy this bond, and it's convertible at $6 per share, $6 per share. So that's the conversion price at issuance. We have the conversion ratio. It does the math for you. Each bond of par value of $100,000 is convertible into 16,666.67 ordinary shares. So these are the important points in here. You want to look for the conversion price and the conversion ratio, because it tells you how many shares you get. So what we can do is we can take this 16,666.67 and multiply it by the stock price at any given time to see if it exceeds 100,000. If the stock price is $6 per share, it will exactly equal 100,000. The threshold dividend, this is an important term we didn't cover in level 1, 30 cents per share. Well, 30 pence per share, but let's go ahead. I think I'm saying it right, pence. I'm not sure if it's pence or shilling, or I really don't get the breakdown of the pound. So if somebody wants to type in the comment section below what 0.3 is, I think that's pence. 30p? Did they just shorten it as p? Let's go with that. So what's this saying is that only dividends above this amount will affect the conversion price. Now, you know that when a company pays dividends, the share price falls. So if you got an initial conversion price of $6, the company can, in essence, change its dividend policy in such a way that it never reaches the conversion price if they decide that they don't want conversion. So that doesn't seem fair. So most offerings will have a threshold dividend saying, look, we already have a dividend. Any dividends over this will adjust this conversion price. So let's say they start paying 40p per year. Well, then the conversion price would drop to $5.90, then $5.80, then $5.70 to reflect the fact that the dividends are working against share appreciation, right? So only dividends above this amount will affect the conversion price. Change of control conversion price. So if there's a takeover or a merger, the conversion price drops to $4 per share. Sometimes there's not a change of control conversion. Sometimes it's just a put at par. But the holders can rather than get a lower conversion price, can just put the bonds back at par. The issuer call price. Now we said that this is the call in here accrues to the value of the holder, and it does. It's a call option on the stock of the company, but the issuer doesn't want something called overhanging convertibles. What that means is that when it's in the best interest of the holders to convert, many times they wouldn't convert because they get the interest income and they can still sell the bond for what the stock is selling for, because the bond will be selling off the stock at that point. So the company wants to avoid that. They say, look, if it's in your interest to convert, we're going to force you to convert by having this call feature in here. And the call feature will punish you if you don't convert. So there's a lockout period, usually from the issuer call, from the second anniversary of issuance. So for the first 2 years of this 5-year bond, the holder cannot call the bond. After that, the holder can call the bond. Now, let's say the stock price rises above $6 per share for a number of days, typically 5 days. If the average of the 5-day period price is above $6, the issuer will issue a call. The first call is 110% of the call value. So we'll call the bonds for $110,000, but wouldn't do that unless the conversion was like $115,000 or $120,000. So if you're holding a convertible bond that you could convert, let's say it was selling at $7 a share, we can see that this is well worth converting at that point, but you're not doing it just to make me pay you interest. I'll call it for 110%. I'll call it for $110,000. Well, your bond is worth $120 if you convert, but I'll call it for $110. So I force conversion. My call, this call option that the issuer has, is to force the holder to convert. It's called a forced conversion clause. And then we see from the third anniversary of issuance, 105. From the fourth anniversary, 103%. So always at a premium. But typically, even with this premium, it would still punish you if you didn't convert. Another clause that you might find in a bond, a convertible bond offering, is a put clause, a hard put or a soft put. A hard put allows the holder to put the bond back to the company for cash. A soft put, the company gets to decide whether they're going to pay you back in cash, stock, or subordinated notes. That's the issuer choice. You might find that in a bond offering for this is the benefit of the holder. All right, well, let's look at how we can, different ways in which we can measure the value of a convertible bond other than just its bond price or the price of the bond itself. We can look at conversion value, sometimes called parity value. And the conversion value is P0 times CR, the conversion ratio. And we already saw what the conversion ratio was. For the bond that we were looking at, it was 16,666.67 shares. And P0 is just the share price. So this tells us what the conversion value of a bond is. So let's have a look here, and I'll just put a 1 and 2, conversion value at time 1 and time 2. At issuance, the share price of the company is $4.58. 1 year later, the share price is $6.23. So if we multiply it by the conversion ratio, we get 76,333 as our conversion value at issuance. The bond's 100,000 face value. This is 76,333. Clearly not worth converting. The conversion ratio is well below the bond price. But here we have 103,833. So it's above par. It is above par, but we don't know if it's above the bond price. The bond price could be higher because as the stock increases, we'll see later on, as the stock increases, the bond price may be higher. So we may look at this and say, it might be worth converting at this point. But the bond may be selling in the market for a price higher than this conversion ratio. So we're going to see that in a little bit there. But this is basically just one measure of the bond's value is its conversion ratio. The minimum value of a convertible bond. What is the minimum value it can be? It is the greater of its conversion value or the value of the underlying straight bond, which is found using the arb-free valuation framework. So the bond we saw was issued at 4.5%. Well, what if interest rates really dropped? And this wasn't a convertible bond, but it was just a straight bond. Well, then it would be worth a lot more than par. So the price of the convertible bond will either be the value of the bond itself as a fixed income investment without any conversion feature, just the underlying straight bond, or the conversion value, whichever is greater. Another way to look at the value of a convertible bond is to look at its market conversion premium per share. Now we're taking a big leap here and just saying, and we're saying right away, well, it's a premium per share. Could it not be a market conversion discount per share? No, never. I'm going to show you very shortly and on the next slide why it can never be a discount. It's always a premium. The bond will either be worth trading at par, at parity, or it'll be a premium per share. So we want to know the premium per share, which will give us our break even. It gives us the break even price of the stock that we need to arrive at to cover off the price of the bond that we buy. On the previous screen, we saw that we issued the bond at 100,000. So we bought 100. The face value of the bond was 100,000. We divided it by the conversion price of $6 to get the conversion ratio of 16,666.67. But here's the deal: that bond's not going to stay at 100,000. Market conditions change, credit quality changes, stock price moves. That bond is going to fluctuate with interest rates as well. So at any given point in time, we would like to know, well, if we converted it, at what premium per share is the bond selling at? So let's calculate that. That's the present value of the bond, whatever that bond price happens to be, divided by the conversion ratio, which we already know, and that's a constant. That doesn't change, but the numerator changes. So the premium can change. And the premium is this value minus the share price, because we're looking for a premium. So these two market prices can change. So the market conversion premium per share can change minute by minute as the bond price and the share price trades in the market. The conversion premium per share can change. And then we'll calculate a ratio, market conversion premium ratio, which is the premium per share over the share price, to see what percentage of the share price is the premium. It always looks better in an example, doesn't it? So let's do one. Let's calculate the market conversion premium per share. So we're going to need the market price of the bond. We see here convertible bond price on April 4th, 127,006. So there's our numerator, 127,006. And that could be a different price tomorrow, and it could have been a different price the day before. The thing is, this is a market price that's market driven and changes on a daily basis. Divided by our conversion ratio, which is fixed, 16,666.67, minus our current share price, which we're told is 623. Now, here's the thing. This is above the conversion price. $6.23 is above the conversion price. So you would think, well, it must be worth converting. Well, the bond is selling for 127,006. So if you divide 127,006 by 16,000, that is $7.62. Sorry, £7.62p minus £6.23p. I hope I'm saying that right for my British friends out there. So is it worth converting? Well, no, because you can sell it for 127,006. If the share price were at 762, you would be indifferent. But right now, the bond is selling at a premium per share to the share price. I can get 762 per share if I sell the bond, but only 623 if I can convert. If I were going to buy the bond at this point in time, I would have to say, well, I know the conversion ratio is 16,666. The conversion price no longer interests me because I can see it's over $6, but that doesn't mean I'm in the money. I won't be in the money till it rises to 762. Why? That is my break-even point based on the market conversion premium per share. I break even when this premium per share is 0. Why can it never be a discount? What's our premium here? It's $1.39. Our premium's $1.39. Why can it never be a discount? Well, because if it were a discount, you'd have an arbitrage opportunity, right? Let's say the share price were $8 and the conversion premium were the conversion per share were 762. Well, it would make sense to buy the bond, convert, and sell the stock at $8 per share, right? Thereby ensuring that this can never be a discount. It will always be a conversion premium. And the day before the call expires, the last day of trading for that convertible bond, for the conversion, the premium will be 0 if it's in the money. What's the ratio? Well, that's easy. We just take our premium, $1.39, divided by the stock price, $6.23. It's trading at a premium. The bond is trading at a premium of 22.32% to the stock price. 22.32. So if you were going to compare a whole bunch of convertible bonds, you can compare them on their market conversion premium, which doesn't tell you much. It's a lot better to look at it in terms of a ratio over price, because now this is comparable to another convertible bond. This is 139. You may look at another one that is, let's say, 265. Well, you can't say that this is better, because this 265 might be on a share price that makes this almost 50% of the value of the stock. Here it's 22.32. So expressing it as a ratio, we can now compare them and rank different convertibles based on this one measure of value. Okay, let's look at another measure of value here. The downside risk with a convertible bond, we can measure something called the premium over straight value. This gives us the downside risk. We take the present value of the bond divided by the straight value minus 1. Let's assume the straight value is 107,52395. In this reading, it's given to you. For us to derive the value of a convertible bond, we don't have the tools. The valuation framework we've been given so far is the right framework, but it would require a lot of explanation and a lot of modifications and adjustments to actually value the convertible bond, because we would need a forecast of all the stock prices at any given time, not just an interest rate volatility, but we'd need that on the stock price as well. We'd have to value a call on the stock price. That's getting in the black shoals and some detail that we don't want to look at right now. So let's have a look at this, the premium over straight value. That's very simple. We know the market value of the bond right now is 127,006 from the last screen. Divided by the straight value, we're given the straight value 107,523.95. So that means if this were not a convertible bond, just on the merits of a straight bond itself, it would be selling for 107. We're paying 127, so we're paying an extra 20,000 for the conversion, for those 16,666 shares that we could potentially trade for. So let's have a look at what that is. Of course, minus 1 gives us 18.11%. 18.11%. That gives us a measure of downside risk with a convertible bond. Upside potential. Well, there is no upside. You can't measure it. It's linear with the share price. So as the share price continues to go up, because you get 16,666.67 shares, the bond price will continue to move up with the share price. And we're going to show you that in the next learning objective, or the next couple learning objectives. All right, let's just take a brief look at valuation. We're not actually going to do any calculation. We just look at the process here. So the value of a convertible bond is the value of the straight bond plus a call option on the issuer stock. We already knew that. The issuer call, which is embedded. Every convertible bond has an issuer call option. It's called a forced conversion option, or it is to force conversion. Suddenly the value of the convertible bond becomes the value of the straight bond plus the stock call option minus the issuer call option. Well, if a put is also embedded in there, the value of the convertible bond becomes the value of the straight bond plus the stock call option minus the issuer call option plus the holder put option. Now, we've done a straight bond, we've done a callable bond, we've done a puttable bond. I don't think it would take much to see how we can combine a call and a puttable bond. The trouble is the stock call option. So valuation using a binomial tree proceeds the same way as we've always done it, but now we also need some forecast of share price per period. Not just interest rates per period, but share price per period. So you can see how a little bit more complex that will become. We're not going to go that far. You just really should know that there could be a potential of 3 options within one bond on a callable bond. A convertible bond. All right, our last learning objective here, compare the risk-return characteristics of the convertible bond with the risk-return characteristics of a straight bond and the underlying common stock. Well, let's start with our 2 lines here, one representing the stock price, one representing the bond price, and the straight line across is our conversion price. So over here, when the stock price is below the bond price, it will trade as a bond, and the risk-return characteristics will be the bond risk-return characteristics. Interest rates and credit spreads dominate the valuation process. It's called a busted convertible. It's kind of a neat term, a busted convertible. The convertible bond price behavior similar to the straight bond price behavior when it's simply not worth converting. As the stock price turns up, it starts to push the bond price up, and you can see they start to really approach each other at high prices. At between, let's just get some lines in here, between roughly here and all through here, the security will trade with stock risk-return characteristics. And within here, where it's transitioning from one state to another, it will trade almost like a hybrid security. So as the share price increases towards the conversion price, the convertible bond price increases, but at a lower rate than the share price. Returns converge when conversion price is exceeded. So you can see how the returns would start converging. So you can see the sharp rise up here, whereas this is going up at a steeper rate. But as we start moving up into here, you can see that these 2 returns are following sort of the same trend. Here in the final stage, when the share price is just increasing, we're way above the conversion price. Well, we have been throughout the whole process, right? The price of the bond here is said to be trading off the stock. In other words, it's not trading like a bond anymore. It's trading like 16,666.67 shares. And the risk-return characteristics here is stock equivalent risk-return characteristics. The convertible bond price behavior is similar to the underlying share price behavior. So at very high share prices, if the share price were up 2% that day, the convertible bond would show the same return characteristics as well, would be up 2% as well. So when it's below the conversion price, you have bond behavior. When it's above conversion price, you have stock behavior. When it's in a narrow band around the conversion price, you will have a little bit of both depending on the sentiment of which way the market thinks the underlying stock is going. If it thinks that, yes, it's going to make a run, it will start to act more like the stock at that point. that takes us through this reading. We're done. Our next reading is credit analysis models. It can be brutal.